Hello again, it's Greg Joseph Chuck, your premier Lake Norman real estate agent with Century 21 Lord & Lawrence here in beautiful Mooresville, North Carolina. And today, once again, I'm excited to be at the Mortgage Planner's office in Davidson, North Carolina, talking to Jacob Roche. Jacob, thank you again for hosting me.
Yeah, thanks again for having me.
No, I'm excited to be here. Thank you. So I know we've covered a couple of topics in the last couple sessions that I was here for. Today I'd like to talk about, or this session I'd like to talk about investors. We are seeing a real uptick of investors coming into the area here. I get calls almost every day, certainly every week, from investors, and generally speaking, they're either buy and flip investors or they're buy and hold investors. And I know that you have announced recently kind of a series of packages that you have that are really aimed towards the investor community.
Yeah.
I believe one of them that's pretty popular is something called a DSCR.
Yes, sir.
And if you could maybe explain what that is, what does DSCR stand for, and how does an investor qualify for it, and why are they excited about these packages?
Yeah, DSCR, really hot topic recently. I mean, a majority of, and sometimes I have investors come in and say, I want DSCR, when they can qualify for conventional sometimes even. So what I say is DSCR stands for Debt Service Coverage Ratio. Easiest way for me to explain it, this is a complex loan, so terms can change as rental income comes in, and I'll get more into that. But, so typically what I say is that you'll go under contract on a property, and this is for a purchase. It also works for refinances too, but again, pretty complex there as well. So when you go into purchase, let's say you go under contract, I tell you your payment's gonna be $2,500, for example. I'll send an appraiser out there, he'll do what's called a 1007, it's a section of an appraisal that is essentially an appraisal with rent comparables that I've rented recently around that area. So if I tell you payment's $2,500, appraiser comes back and says, hey, perfect, this is $3,000 to rent out per month. Perfect. DSCR ratio, it's well cash flowing, right? Now, if the appraiser comes back, says that this property will rent for $2,400, okay, that puts your DSCR ratio in that bracket of 0.75 to 0.99. So essentially, it's not covering the payment completely. We're looking for 1-to-1 ratio or over. I can still get the deal done. Your rate I might say, hey, if it's cash flowing, I'll give you, I priced one earlier, it was 6.625. So perfect, that's great terms. Now, if it's not cash flowing, just a little bit of loss, call a few $100s per month, you're in that bracket of not cash flowing. So your rate might go to 7 to 7.5 area. Now, I've had one time ever, I said payment was $3,000. It was at a townhouse, 1 block from the beach. Appraiser went out and he said this will rent for $1,600 a month. Now I said, if I can rent out a place for $1,600 a month, 1 block from the beach, I'll move there tomorrow, right? So I told the appraiser, I said, well, this is a short-term rental. You don't think, and he said it accounts for seasonality, and he ran whatever kind of calculations that they have in the short term. So that happened one time. My client, his rate went to 9.5. He still closed. He went forward with it. I wasn't a huge fan of the terms, obviously. I was kind of disappointed, but because I went back and forth with the appraiser. However, he was cash flowing 4 times the payment in some months. So he came back to me 12 months later and said, here's my 12 months Airbnb statements. Give that to the appraiser. Now, he has evidence to back it, opposed to being a little bit more on the conservative side because he's not unsure of the North Cops Hill market, let's say. So now, point being on that story is that the cash flow, I would say, is about 0.5 or under, so that's called DSCR no ratio. So when I say complex, really the complexity behind it, make sure it's cash flowing, in other words, but there's things that we can do to get around that. We can make it interest only. We can look to shop your insurance. We can buy down the interest rate. There's just so much that we can do to make it look the cash flow, maybe a little bit more down payment. It is the hot topic. It's the hot product out right now that I would say several per month that we're closing that investors are looking. It makes it really easy on them because I don't need all the documents for any of their other properties. I'm really mainly looking at their primary and then subject property.
So are you only looking at the rent coming in as revenue and the mortgage payment, the loan payment, being 1-to-1, or is it, plus the property taxes, plus the maintenance, plus whatever costs may be involved?
Great question. So just mortgage payment, PI, TIAA, so principal, interest, taxes, insurance, any association dues. So condos, those can be a little tricky too. And then towards the rent. So, and no, we're not taking up maintenance. We're not taking any of that into account.
Okay, great.
So that's been the hot topic. We can go as low as 20% down. Oh no, I'm sorry. We actually just came out with one with 15% down. Again, the cash flow is the biggest piece. So if you find a really great property at a great price and it cash flows, that's perfect for that. Now, 20%, that's typically where we start to see a cash flow in this area at least.
And are there any other kind of loan options for investors that you can think of that besides this program, which sounds fantastic, but are there other, and let me, one other question I just thought it popped into my head. Do you require like W-2s on any of this or tax returns or anything like that?
Nothing. No job, no income, no employment. So, I mean, it is a great program for any investors that they just have a rental portfolio. They want to go buy the next one, but bank might tell them, or Fannie Mae, Freddie Mac, in other words, are going to tell them, we need your tax returns to qualify you. If you're not showing your income on your taxes and have a lot of write-offs, well, they're not going to give you a loan on for $300,000. Now, if we go property-based, that can be obviously we can get you a loan there with no job, no income. Now, also one thing that I left out is in addition to, this is a business purpose loan, so we can add a prepayment penalty. So it can go years 1 through 5. And really what that means is that if you prepay, so if you pay off the mortgage early within that set amount, meaning 1 to 5 years, it's a 5% penalty. However, it makes your interest rate significantly better. So if you're planning to hold the property, you're like, hey, I just want to hold this for the next 30 years, pay it off, at a 5-year prepayment penalty, I'll be probably lower or just right at market for if you're buying a primary at 20% down. So that product, that's the one great way to it, is the prepayment penalty, which I don't think a lot of people really know too much about. The more you add, the better rate you get. It's pretty cool.
Yeah, very neat, very neat. What other potential loan packages are out there for investors?
Other products, there's conventional being the biggest one. Again, we need W-2s or tax returns in that case, depending on how you're paid, like I've said in previous sessions.
Excuse me, is that a commercial loan? I mean, can you get a typical mortgage if you're an investor and this is, your 5th or 6th property and maybe you have it set up as an LLC?
Yeah. So you can close in your LLC. You can close under the LLC, which is great. In terms of other loan products, I mean, there's fix and flippers, other loan products out there. They're a little trickier with being renovation loans, I typically say. But conventional, so what I always say is conventional, typically easier going fix and flip there. DSCR is a little bit trickier. It's not no employment, right? So conventional, that's easier on the renovation loans. It typically, there's no quote unquote risk. In other words, will the rent come in? Please come in good, right? So I typically say that conventional is the easier route if you want your terms safe. That's what I always say. Okay, and I have one more area because I hear some investors say that, hey, if you've got existing property and it's got good equity along, maybe do what we call a HELOC, right? Yeah.
Home equity loan. Can you maybe explain where are the rates nowadays? Does that even make sense? Pulling that equity out and rolling into another property versus maybe doing something like a DSCR? So
what I say, HELOCs or home equity line of credits on investment properties are typically pretty rare. So there are some that offer it. However, you might be better off going to get a private money lender. Your rate might be at 15% is kind of where I say. So yeah, pretty high. But what I always say is that there's record high equity in homes. I just had a client come to me with a commercial property. I don't do commercial. I'm sorry. However, his primary house is paid off. Well, I refinanced $300,000 cash out. It's like 50% loan to value, and he just went and paid the commercial property in cash. So what I'm typically having is if you're going to buy a bunch of properties, you might want to pull cash out and then go 20% down on a few different properties, and you got 5 properties under your belt with 1 mortgage payment on your primary. And honestly, you could even do a HELOC, home equity line of credit on your primary too. But any seconds I say on investment properties are pretty rough right now? That's a great question. I get that often.
Yeah, great. Well, hey, listen, I know that our time is coming to an end here, so I want to thank you for running down the different scenarios. And again, if you're an investor and you're looking for different types of options, I recommend giving the mortgage planner a call. Give Jacob a call. He'll be happy to work with you. Jacob, thank you so much. Appreciate it.
Thanks for having me.
You're welcome. Thank you.